I'd like to welcome you to Insights into Market Profile. And this lecture series should benefit traders of all levels. A little bit of market knowledge would be helpful. However, excuse me, this will even, benefit even novice traders. So let's jump right into it and get into market profile. The market is set up into a two-way auction process. And this two-way auction process, prices will move up in order to shut off buying and find sellers. And the market moves down to shut off selling and to find buyers. And it does this through what's called rotations. And these rotations are basically a 30-minute time period. And the market profile graphic is set up to print what's called TPOs, time price opportunities. And each one of these time price opportunities is given a letter. For instance, from 9:30 Eastern Standard Time to 10 o'clock is the open, and it's called A period. It's A rotation. And then at 10 Eastern Standard Time to 10:30 is B rotation, and so on. And there are 13 rotations in a trading day, A period through M period. And these rotations cross through price and build the market profile, the Gaussian distribution. And the importance of this time is it's called time regulates the market. Time puts pressure on all of us. If you're getting close to the close, traders got to dump in their shares or they got to get out of the market. So time puts pressure on you. And that's why they say that time regulates the market. And it's said that if price crosses, or if the rotations cross through a price many times, there's a lot of business to do at that price. And it will build a distribution. Like as you can see here, you've got a nice distribution up here at the 1885 level. And you've got a distribution here on this profile, down here on this 9th of February. It's built a lot of rotations there. And so there's a lot of trades to go out there. And it builds a value area high, a value area low, a point of control. And these numbers on the side of the market profile graphic show you how many times that price movement moved through that particular price. So as the market progresses through the day, you'll see it'll build an area of value. It's called a value area. And this value area is where 70% of the trades went off that day. So this is a perceived area of value, and it's where the market's comfortable. It's able to facilitate a two-way auction process. This is usually formed by shorter-term traders, such as floor traders or scalpers, or even day traders. And, all of these types of traders trade a little bit differently. Scalpers will get in there for a couple of ticks or a point. A day trader would buy or sell the open and go home flat that day. And so this would be an area where that type of trader would like to keep price and keep trading in there. There's less risk. So as the market progresses through the day, it's going to cross the price the most amount of times, and that's going to be called the point of control. So in an example here, you can see this point of control was 62.75, and it had 12 TPOs, meaning price crossed through that price 12 times. And that's an important area for traders, especially scalpers and short-term, to facilitate trading. Okay. And so, moving on, our market profile graphic is also going to show us something called the initial balance. And the initial balance is nothing more than the first hour of trading from 9:30 Eastern Standard Time to 10:30 Eastern Standard Time, which in market profile terms would be the combined A and B period. So as you can see here, the B period up here at this 1870, that's where the letter B had printed at its highest point. And its lowest point here in A was down here at this 5550 level. And you can see in the market profile graphic, and this is just my system, it prints it, the initial balance is green so that I can see a breakout of the initial balance, on either side of the initial balance. And of course other platforms will show that differently, whichever way they have it programmed or coded. Okay. So that's going to be some of the important information that the market profile graphic gives us. What type of traders may be where, and where breakouts may occur. Above or below the value area. And it's like this because, different traders have different trading behaviors and trade for different reasons. And as an example, larger traders have the inventory in order to move the value of the market higher or lower. And smaller traders, retail, scalpers, really don't have that much inventory to move the value of the market higher or lower. And I'm not talking price, I'm talking value. So as you can see here, later on we'll get into discussions of value. And you'll see here, this basically would be called a two-day balance. And you can see here large traders were able to move the market higher and have a little bit higher of a value area. So what you have here is, toward the end of the day, the market comes back into the prior day's value area, which means in range of the prior day, and in value. And so by even looking at a single market profile graphic, we can look at how the market is progressing through the day and the behaviors of the different types of traders in the market. And where they may facilitate trade. The market is a very dynamic thing, and the point is to develop a market logic that's, progressive and dynamic in order to understand what might happen where. We know that large traders, especially commercials, trade differently, and they use more of a fundamental analysis. They buy or sell basically on if they believe, a market or a commodity is overvalued or undervalued. And that's fundamental trading. And, hedge funds, to describe, some of the behaviors of these things, hedge funds trade differently than commercials. Commercials say it's overvalued here, it's undervalued there. If it's overvalued, sell it. If it's undervalued, our calculations say it's undervalued, buy it, or whatever. Whereas a hedge fund, which is also a large time frame trader, trades for the fund, just, the price movement of the fund. So when they move the market, and they have, enormous inventory also, their trends don't last as long, maybe a couple days or a week, because they just trade for the, the price of the fund, and then when it makes enough, they'll get out or wherever. And whereas like a commercial trader really has a vested interest in a commercial enterprise, like Frosty Flakes or something, and the price of corn. They need to lock in prices of corn at a certain amount. So they're a very long-term trader. They trade from months to years. And, funds, and they're all types of funds, trade for their fund. And some trade, like hedge funds, and then, mutual funds would trade basically, time. And the reason is this, because of short-term and long-term capital gains taxes and these kind of things. The long-term capital gains taxes is after 3 months, and, it's a lower tax, so they may get in there and just move the market for, a little while. And the commercials, hedge funds don't have they're not, they're more of a derivative, and, they don't have a vested interest in a retail enterprise, like, locking in the price of cocoa so they can make candy bars or something. And so, that's how they trade. And then you have, daytime frame traders and swing traders. And your swing traders are basically in the market 3 to 5 days. And you would get information from them basically off a weekly chart. And then you have, the floor traders who have to move price to connect these buyers and sellers. I mean, that's basically the function of the exchange, and why it was set up historically was to match large buyers with large sellers. And so they're kind of like a chain link in between. And so, if you have like, Coca-Cola wants to sell corn because of corn syrup, at a price, uh, the floor is going to have to match a large buyer with that large commercial seller, and it's usually a fund or something like that, because retail and the exchange themselves, they just don't have the inventory for that. So they're kind of like a chain link fence, and they may have to move price through these rotations in order to trigger, trading, and then, lower the price for these other large traders to come in and buy, some of that, or they end up eating the overflow, really. And so that's some of the many types of traders in there who can form the market profile and how the value of the market is moved, why it's moved, and where it may go. And what I'm going to do for Lecture 2 is I've written up a sheet that has a lot of market profile terminology in it. I'm hoping that you're going to take a look at it and study it and familiarize yourself with some of the terms that we're going to be using, as we go through this lecture series. And later on, we'll get into reading the market profile graphic and into a little bit more detail about what we're seeing. Poor highs, poor lows, anomalies and nuances, and all these different kind of things that will go on. So I hope you'll take a look at that, and I'd like to thank you for your time, and I hope to improve your trading here in the near future. So thank you very much for your time.